Good morning everyone. I am Nilakshi Arora, Assistant Professor, Department of Commerce, the Bhopal School of Social Sciences. Today I am going to take a very small session on valuation of goodwill. In this session we will be discussing some basic concepts regarding the valuation of goodwill, what is goodwill and how goodwill is being calculated. To begin with, let's understand what is the meaning of goodwill. In normal words or in normal scenario or in business studies, we have studied that goodwill means reputation of the business. But in accounts, we should convert this definition into accounting terms. Let's say that the excess earning capacity of business is goodwill. This is the very basic definition and we must know it, that the excess earning capacity of any business would be goodwill. Now, what is excess earning capacity? So, we will understand this by a very basic example. Like we have two shops, shop A and shop B. Shop A be the Domino's and shop B be the Ram Kumar's Pizza. Now, both the shops are going to give you the pizza at same price and the quality would be same. Still, you as a person would go to Domino's. Your preference would be Domino's. Why? Because according to you, Domino's is having a brand name, or in technical terms we say that Domino's is enjoying its own goodwill. So, we say that if somebody is earning something more than the normal profits which the industry as a whole is going to earn is goodwill. So, we can conclude goodwill means monetary value of the reputation or image of the business. Now, goodwill is an intangible asset. Intangible asset means it cannot be seen, it cannot be touched, it can only be felt. Goodwill can be classified into two types. One is purchased goodwill, another one is inherited goodwill or non-purchased goodwill, or it can be self-generated goodwill. Now, what do you mean by self-generated goodwill? Like I have a business and it is being continued from past 10 years. Now, I am going to enjoy some brand name, I am earning something more than the same type of industries in the market, that is my self-generated goodwill. You cannot record that self-generated goodwill in the books of accounts, because as per the basics of accounts, it is said that any anticipated profits or the profits which cannot be converted into monetary value or for something for which you haven't paid the amount cannot be recorded in the books of accounts. So, always remember one golden rule, that the self-generated goodwill is never recorded in the books of accounts. It is there, you enjoy that goodwill by earning the excess profits, but it shall never be recorded in the books of accounts. Now, second type of goodwill is purchased goodwill. From where do we get purchased goodwill? Like I today plan to buy Tata. So, I am going to pay something extra other than the book value of assets and the liabilities. That extra I am going to pay would be for goodwill. So, that is one basic thing, from where do we get purchased goodwill. Another categories can be like in case of admission of partner, in case of death of partner, in case of retirement of partner, we also calculate the amount of goodwill. Now, we will move further and we will be studying the methods of valuation of goodwill. This is one of the most important topic of corporate. There are basically four methods. One is average profit method, super profit method, capitalization method and annuity method. Before moving to these methods, let's understand the three basic terminologies that shall be used in these formulas. One is the future maintainable profit, or we simply say it as maintainable profit. Second one is number of years of purchase. Third one is capital employed. These are the very three basic terms which we need to understand before we jump to the formulas. First, we will understand the capital employed. What do you mean by capital employed? Capital employed in simple terms means market value of all the assets minus external liabilities. In other words, we can say that the amount or the capital invested in your business is your capital employed. We always give priority to average capital employed. Now, how do you calculate average capital employed? Closing capital employed minus half of the profits earned in the current year, or opening capital employed plus half of the profits earned during the current year. Now, there are certain things which you need to remember while calculating capital employed. Like First one is, you might have some goodwill in your balance sheet under the category of intangible assets. You are not going to consider that goodwill because you are already calculating the value of goodwill. So, if you are going to get the end result as goodwill, you cannot take another goodwill in your capital employed. So, we are not going to consider goodwill, first point. Second point, fictitious assets are not to be considered. Fictitious assets means discount on issue of shares, discount on issue of debentures, preliminary expenses, incorporation expenses, such items need not to be considered. External liability here means what? All the types of long term liabilities, all the types of short term liabilities. So, what is the ultimate formula you have? You have the last formula as capital employed is equal to market value, that is the price at which your asset can be sold in the market minus all your external liabilities. To conclude capital employed, we can say that the capital employed means the market value of the capital invested by you. Second item we are going to understand is number of years of purchase. Number of years of purchase indicate the time required by new business to come to a level equivalent to the old settled business. Say for example, I want to open a restaurant. Okay? To come to the operations or to earn some certain normal profits or certain extra profit, it would take 3 years to build my reputation in the market. So, we say that this 3 is your number of years of purchase. Now, third most important thing that we are going to understand is the calculation of normal profits or maintainable profits or future maintainable profits. What do you mean by this? We will understand this by taking a very small example. Say for example, during the year I earned a net profit of rupees 1 lakh. This net profit I might have reached by adding all the incomes and subtracting all the expenses. There are certain expenses which are of non-recurring nature or they are not operating, meaning by that they do not contribute in goodwill in any manner. So, we need to adjust that back to the profits. Incomes are added previously to the P&L account. So, here we are going to subtract the incomes. That is why I have said less all abnormal gains and profits that are of non-recurring nature or non-operating nature. Examples can be profit on sale of machinery, certain rent received from certain property, or it can be interest received, it can be dividend received from securities, and we are going to add back all the abnormal expenses, all the non-operating expenses and all the non-recurring expenses back to the net profit, because these expenses shall not be incurred in the future. Examples of certain expenses can be loss on sale of machinery, certain interest paid, it might not be incurred in the future, so we are going to add it back. Lastly, we are going to do one more adjustment of all the future expenses and all the future incomes that shall be incurred in the future. So, expenses would be subtracted and all the future gains would be added. By doing this, we will get the total normal profit or we will get the total maintainable profit for 1 year. Same exercise we are going to do for all the years for which we are going to calculate the goodwill. Now, we will understand the formulas. First one is simple average profit method, where goodwill is equal to average profit into number of years of purchase, where average profit is total normal profits divided by number of years. Next one is weighted average profit method, where goodwill is weighted average profits into number of years of purchase, where weighted average profit is total of products of profit divided by total of weights. The weight is given according to the trend, the previous year is always given the highest weight. Next one is super profit method, where goodwill is equal to super profits into number of years of purchase, and super profit is calculated as actual profits minus normal profits. Normal profit means capital employed into rate of profits generally earned by the industry, that is NRR divided by 100. Next is capitalization of average profit methods, where goodwill is capitalized value of average profits minus capital employed, and the formula for capitalized value of average profits is average profits into 100 divided by NRR. Next one is capitalization of super profit methods, where goodwill is equal to super profits into 100 divided by NRR. The last one we have is annuity method. In annuity method, we consider the present value factor instead of number of years of purchase. If the present value factor is more than 1, then the formula of goodwill is super profit into present value factor. If the present value factor is less than 1, then the formula is goodwill is equal to super profits divided by present value factor. In this session, we understood the basics of goodwill and we also did the formulas for calculation of goodwill. My dear children, in the upcoming sessions, I will try to explain you these formulas in depth and we will be also doing certain numerical questions based on these formulas. I hope this was a fruitful session for you. Hope to see you very soon. Thank you.